Hello, everybody. Welcome to Your Bread and Butter Podcast. I'm Andrew Boudry.
And I'm Ryan Cummings.
We're going to see you in a moment to talk about the fine print of being an adult, how to read financial statements and basic insurance policies, just like an expert.
All the numbers, terminologies, jargon that you need to know. That way you can decipher these policies with ease and know exactly what you're getting into.
See you shortly.
Discussions in this show should not be construed as specific recommendations or investment advice. Always consult with your investment professional before making important investment decisions. Securities offered through Cambridge Investment Research Incorporated, a registered broker-dealer. Member FINRA SIPC. Advisory services through Cambridge Investment Research Advisors Incorporated, a registered investment advisor. Cambridge and Private Financial Design LLC are not affiliated.
Bread and butter.
Welcome back, everybody. It's the fine print of being an adult. How to read financial statements and the basic insurance policies like an expert.
Life does get busy, and it's easy to let some responsibilities slide. I think we, like most people, we all like to kind of entrust and put some of the responsibilities of life onto other individuals, other professionals. You have bankers, lawyers, financial advisors, doctors for your health, insurance agents for home and auto, customer service individuals for things like your 401k. So we, delegate all this responsibility to these other individuals, trust that they're ideally working in our best interest and helping get us, the products or the insurances or the coverages that we want. But do you really know how to read these statements and make sure that you're actually getting what you're looking for? That's the goal of today's episode. We want to walk through a couple examples, point out some of the key things to look for, to pay attention to within some of these different statements, and help essentially do your own detective work to make sure that
Correct.
you're, having checks and balances.
And it doesn't matter whether you get paper in the mail, snail mail, or you get emails. It's important to decipher what's going on. Now, the reason why we're asking about have you be an expert is, do you know what it means to spurt? It means spurting is an erratic, unorganized burst of energy that can be positive, but it doesn't sustain itself. So our time together today is to help you be the opposite of that when it comes to understanding about how to read these statements, how to read these policies with a steady and consistent questioning process where you no longer spurt with starts and stops. Oh, I'll read this. I'll read it later. I'll read this. I'll read it later. No. You'll be an expert. You'll do it consistently.
I like that. Stop spurting.
Stop spurting.
So I think the goal, though, to give a couple quick examples of today is, I've seen all too many stories from clients and even family, friends where, let's say use insurance as an example. I think it's an easy one. They maybe had some damage to their car, were in a car accident, or maybe a bad storm came through and had some damage to their home. Go to file an insurance claim, and maybe it only covers a fraction of that damage, or certain things maybe weren't even covered altogether. I've seen all too many stories, heard, all too many scenarios where that's happened, where people, and it wasn't that they bought the policy expecting that, they actually fully expected the policy to cover all the damages or all the expenses. And when it comes time to file, there's that fine print. There's those little words in there that exclude these things or have limitations on it, or have scenarios that are outside the boundary of those policies. And so that's the goal today, is we want to avoid those situations for you guys, so you're not falling into that scenario of, well, when it's time to actually use the policy, it's covering less than you had hoped.
And the same thing's true for your investment policy statements, your bank statements, anything, any kind of coverage, anything where
health
you're getting
insurance bills.
Health
that's
insurance
a big one.
Bills. Yeah. So let's start looking at home and auto insurance coverage, declaration pays, to see if you can find some savings or if you are underprotected. So when you look up there at the screen, obviously there's personal information has been redacted. This is a car insurance type of policy. And basically, as you go through and you look at this, you're going to see that you have some liabilities. You can see the line of interest there. If you go over, you'll be able to see the deductible. Most people don't pay attention to this. So your deductible, if you have a $500 deductible, you're going to pay a certain amount of premium. If you have a $250 deductible, you're going to pay more premium because the insurance company has more risk for coverage. $1,000 deductible, they're going to have less risk, so it makes your premium less expensive. But can you afford a $500 deductible? Can you afford a $1,000 deductible?
And for those of you that maybe aren't super familiar with that term, it's just like with health insurance. It's the cost you pay out of your pocket before insurance pays anything. So if you have a home repair that's going to cost 10 grand and your deductible is $500, well, you pay $500 and the insurance company pays the other $9,500. So to your point, smaller deductible, more expensive plan. Bigger deductible, cheaper plan, but when it comes times to use that plan, it will be more expensive at that time. I'll even give a quick example, even for myself. We recently had some water damage, a leaky faucet within our house, and so we're utilizing insurance to help with some of the repair costs. Well, our total cost of these repairs were somewhere in the realm of 12, 13 grand. Did a decent amount of damage, got into the ceiling of our home, and our deductible is $1,000. So of that 13 grand, we're subject, even though we pay for this policy, we're subject to paying the $1,000 deductible, and the insurance policy pays everything else that's within that coverage. Now, we were expecting that. We knew that was our deductible, so that wasn't a surprise. We'd kind of planned that out. Our plan's a little bit cheaper for having a slightly larger deductible. But the reason I'm mentioning this personal story is we actually, when we had the damages in the first place, we went in, tore some of the drywall down, got some fans going, some dehumidifiers, and kind of helped dry everything out. We just kind of did that off of, thinking, well, there's water everywhere. We got to clean it up. Well, in conversations with our insurance company, and this could be something that some of your listeners could even consider doing too. We did this by accident, but it was a good learning experience. That was something that technically the cleanup was something that was covered under the insurance policy. We could have hired like a ServPro type company to come in, bring in their industrial fans, do all the mitigation of the water and everything to make sure there's no, future like mold damage or anything like that. Well, in discussions with our insurance company or insurance provider, that was all mentioned. They actually waived our deductible because hiring a company like ServPro would have probably cost $2-3 grand to bring them in to do that same work. So point being is there's even a chance where, depending on your insurance company, not every insurance company might be that nice, but there is a chance to even maybe have your deductible waived if you do some of the work, if you do have to file an insurance claim.
Yep,
so hopefully
exactly right.
Hopefully just a helpful scenario for anyone dealing with
That's a good scenario. We've had water damage here. We've had to make claims, and on this auto policy form, you're going to see over here on the left, it says rejected. Well, actually, in this vehicle coverage, this is not actually rejected because it all goes on to the liability policy for the master policy for the business and this other liability policy. But what you see down here is basically the value of the vehicle that's being considered. Now, if you look at that number and you go, wait a second, that car's worth $64,000 and it's saying it's only worth $32,000, you might want to make sure you got the right coverage. So over here on the right-hand side, in the second piece of this, you can see here that it says towing's been rejected, the collision's been rejected. Actually, that's all on another policy. But the part you want to really look at is the comprehensive insurance. So comprehensive insurance on an auto is something that helps with the whole idea of getting, in an accident. It's comprehensive. Right. It's going to cover something that goes on in an accident. But you'll notice up over on the right that there's still a deductible, a $500 deductible for that. Then you have all the auto liability, which was rejected earlier, but now you can see it listed there. You'll notice in the liability section, it has, $100,000, $300,000, property damage at $100,000. So in your state, depending on where you live, they may have requirements. Massachusetts has minimum requirements for your coverage.
Right.
Normally,
not every state has this, but Massachusetts does.
Not every state does. Massachusetts does. But I normally would say to people, it would be a really good idea to have more liability coverage than less. Yes, you can have the bare minimum. It'll protect you. But if the damage is far greater than what your policy covers, you may be sued in court to have to come back up with that money.
Right.
So this is actually a good area for you to check on your policy is what is my liability coverage and do I have enough? Am I underinsured here or am I at the right number? Very important to know.
And one additional thought on that number too is you want to also, depending on your net worth and depending on if you're a business owner or the vehicle's through a business, you can also try to coordinate that with some umbrella coverage, or otherwise called excess liability coverage. If you get a certain amount through the direct policy, but you feel like you need more to maybe protect your business or protect your home or something like that, well, you can go with instead of just racking up all the liability coverage on your auto policy, you could get a often, not always, but often cheaper excess liability policy to kind of coordinate with the liability coverage that's attached directly to your auto.
And I've watched this happen before, where we had one of our work vehicles was struck in a local parking lot. I actually watched it happen, and the person or the plate that I got off of the number, because it was a younger person who was having an emotional experience, sideswiped the vehicle. And I got the number off the plate, but it was a temporary paper plate. And when I turned it in, it turns out that the temporary license plate had been stolen off another vehicle. And there was no other witnesses. I didn't have anybody around. So I ended up having to pay for all that damage myself, because it's not really covered underneath here. Uninsured or underinsured, with
that's a big one. Yeah.
That's a big one, but that's for where you can actually prove that the person, you have proof there that the person did it, and you can find out whether they're insured or not. But
yeah, because you never know if you get in an accident and you have your proper insurance, but let's say it was the other person's fault. Normally their insurance would cover it, and they don't have insurance. Well, you want uninsured or underinsured coverage on your own policy to pick up the slack.
Absolutely. So on that note, let's look at a few items here. So I really like looking at some of these definitions. They're a little bit weird, but I don't know. I mean, I get a kick out of this because I read through some of these documents and I think, does anybody ever really read this? Am I the only one that ever reads this stuff? So it talks about here the coverage territory. The United States of America. You look over here on the left, Puerto Rico, Canada. Here are some local places that you can get coverage. But notice it doesn't say Mexico.
It does not.
So the reason why I bring that up is I had a client that had a car issue that happened in Mexico, and they had a car insurance that would cover them for a rental car, but not in Mexico. So they ended up having to fund it out of their pocket. So I thought, this is probably a pretty good thing to remember.
Right. Yeah, I think all the more reason where if you're traveling and you get a rental car, and they always ask if you want the additional insurance. Actually, that's a very good point. I didn't even think of. I usually actually turn down the extra insurance because usually your own personal policy will cover the rental. But that's good to know that you need to read that fine print because you're in Mexico and you might need that extra insurance.
And with things the way they are today, you want to make sure if you're traveling in Canada, of course, it's unlikely you and I are going to bring our car to Puerto Rico, but we might rent a car there. But you got to check your policy to see which territory. Now, the next one here that I actually get a kick out of this, I really do. Nuclear energy liability exclusion endorsements. All right, Ryan, I'm going to let you handle this one.
So we're looking at if we were ever in a nuclear explosion of some kind.
They don't cover.
The car is not covered.
Not going to be covered. Yeah. Just in case, you might have that in your policy as well.
Right.
I just thought this would be a good one to look at.
It's a funny one, though.
Nuclear energy liability exclusion endorsement. Yeah, so there you go. That's,
So the little things in the fine print that and I'm sure the average person doesn't read their policy and doesn't realize something like this is even in there.
All right. Let's talk a little bit about investment statements. So the reason why I bring a ladder to read my investment statements is because I have a lot of high yield stocks.
Okay.
Let's look at this statement for a moment. Dive in.
Yeah, so when we've got a traditional investment statement, we're using one from, yours may look a little different, but a lot of the information should cross over. We're using one here from our broker-dealer. Cambridge Investment Research. And so you can see on these first 2 front pages, a lot of it is just summary information. So on the left side, just simple balance and growth trajectory. You can see the growth of the overall account value over the number of recent years. But then as you get into the account overview, you'll see a breakdown for the period of the statement, which for this one, I believe was just a month of January. You're looking at the overall summary of performance. So this page might be we'll look at some other pages in a second. This page might be 90% of the information that you're going to need.
And every one of these redacted points here is your account information is up there, your address. You want to make sure all those things are correct. And then as you get to this account overview, you're going to see, all right, year to date, this is what the portfolio's done. And that particular period, whether it's month, or, that month or quarter, if you get quarterly statements, this is what it's done. And then you can break it all down as to any taxes that were withheld, any dividends that were paid out. You can see all of that down there. And then to the right, it tells you where, like in general, your assets are. You've got cash, you got bonds, equities in there. Everything is over in that side. So you're right. This one page tells you everything.
Right. And it's if you want to dive deeper and look at the actual stocks, the actual bonds, the actual mutual funds that your portfolio is holding, how many shares, what the overall value is of each. That's where you get some of these holding pages, where it'll actually break down how much is that stock worth, how much is that fund worth. You even see here when you're getting a cost basis column as well, that's showing you what you bought that stock for. Because as many of you might know, if you buy a stock for one price and you sell it for more, you got to pay taxes on those gains. So this is kind of breaking down all that individual information on each individual holding within the account.
Yeah, and as you go across that board, you can see, again, what you've paid for it. If there's any dividends that have been reinvested, it all shows up in there. And it gives you each asset listing. So, if you really wanted to be curious, you could go in and take what they call the QSIP number, or the number for the symbol, and you can actually plug it into Google, and it'll tell you about who's managing it and all of that. Now, obviously, some of these, if you got 100 stocks in your portfolio, it can be a little challenging to do that. But the truth is, you can find out every single thing about the individual portfolio that you have. Now, in a managed portfolio, by the way, sometimes you might look at it like, all right, I got 45 shares of this stock, and then I've got 212 shares of this stock. I mean, how's that all decided? Well, it may be that the shares where you're holding 45 shares in it is worth, $10 a share, whereas the one that is, $245 a share might be $5 a share. And so they're going to hold more of it to get the balance of what they want. But if you're in a managed portfolio, it doesn't matter the number of shares, because the people managing it, those are the ones that are picking the valuation on how many shares to hold within your portfolio. Also, you'll notice here an estimated income. So when you look over in the right and you see an estimated income, all that really is if there's any dividends being paid by that particular holding, it's going to show up over there as to what the dividend income might be.
And that's even what we'll see as you get further into the statements. We'll even start to begin to see some activity pages that will show any contributions to the account, any debits or withdrawals from the account too. And then also even activity like the interest that maybe your bonds pay, your dividends that your stock pays, those will all be on some of these pages too. So,
and most importantly, the fees. Whatever fees you're paying, they're right in there.
Exactly. It shows the breakdown of everything. So you can actually see, what's coming in, what's going out, what form of it is just gains. Because there's 3 types of income in an investment portfolio. Most commonly, there's your capital gains, your dividends, and your interest. And you want to break down, how much is coming from each. And especially in an account like this, though this one we're looking at primarily today is a taxable account. So even if you're not touching this money, this is income, your dividends, your interest, your capital gains that are realized. This is all income that you're going to realize in the end of the year, meaning it's going to show up on your taxes. You have to pay taxes on this income. So it's important to, as the year goes on, if you want an idea of, you don't want to just wait till your 1099 comes at the end of the year.
Right.
But as you get to, September, October, November, December, you want an idea of, what's this extra investment income going to look like?
Yeah, because if you go back to that front page, you don't have to do it. But if you go to the front page of your statements, you're going to see, sales that have been made. You're going to see gains on the account. Short-term gains, long-term gains, any losses, all going to be there. And on top of that, when you're looking at this, if you have questions, the dividends are reinvested, you'll see it in your activity of statements. But the footnotes and cost basis information at the bottom of that page, if you want to know how your cost basis is determined, it's all defined within that statement. So this is a taxable investment in the sense of it's non-qualified, it's out in the wild, it's exposed to taxation on gains and things like that. But really, if you're looking at the qualified IRA one, only thing that's different on it, the only thing, is on that second page that we looked at for the non-qualified. It has all your fees and all this stuff. You also on there have a required minimum distribution if you're at that age.
Right.
So if you're over at the age and your custodian who handles the account, not the broker-dealer, but the custodian who oversees it. That's not your advisor. It could be National Financial Services. It could be Charles Schwab. It could be Pershing. Whoever it is, they're going to tell you what your required minimum distribution is for the year, so you'll always know what that number is right on that second page. It'll tell you right there. On that note, just so you are aware, on your statement, if you have an account that's not an IRA, it's maybe owned by your trust or you and your spouse or you individually or with a child or whatever, you can actually pay taxes to the IRS out of that account. They'll actually send it for you, not just an IRA account, but a regular non-qualified brokerage account. You can actually send money to the IRS and pay them with the instructions that you give to your custodian that I want to pay X number of dollars towards the federal or state government for taxation. They'll send it for you. It's a nice, quick, easy feature in case you wanted to use your investment account to pay for the taxes.
Right. And for those of you that, if you're unable to do that, if your custodian for some reason doesn't offer that service, well, the next best option is maybe you make some estimated payments throughout the year. You can always send the IRS a check. There are forms out there that you can, write off a slip, send to the IRS, and get some of those tax dollars paid ahead of time rather than, waiting for some big tax bill that you're unsure of come tax time.
So remember, you'll no longer spurt in your awareness. You'll be an expert. The documents that we showed you today, whether it's your car, your house, check your deductibles. Make sure those are appropriate for you. If you can afford a $1,000 deductible or a $2,000 deductible, do it. It'll lower your insurance costs for sure. Your insurance policies define your protection in a crisis. You don't want to have a gap or an exclusion that makes things financially devastating for you. Understand your coverage limits and the things that would help you avoid being underinsured or overpaying. If you got a $250 deductible on your car, on your house, hey, the insurance agent that writes it, they don't care. They'll make more money on the premium. I'm sure they do care. I shouldn't say that they don't, but the truth is you should care. And so if you can afford a higher deductible and lower your insurance down, do so.
And also, understand your investment and 401k statements. Look at your performance, fees, your risk exposure. Don't just take those statements and throw them in the trash each month. Make sure you're at least taking a look at them. Now, actually, we do encourage a lot of our clients to not necessarily look at their performance and whatnot day to day because the market is always up and down constantly and you'll just drive yourself crazy. But at least on a monthly basis, take a quick look at your statement. See how it did. Make sure you're taking a quick look at the fees, at the performance. Did any investments change? Because the last thing you want to do is, not notice when a fee changed or not notice a portfolio allocation adjustment that maybe doesn't align with something you wanted, or maybe it was something you were completely unaware of that your advisor was going to do altogether. So these monthly statements are kind of your little snapshot into understanding more and, staying at least mostly up to date on your investment accounts and retirement accounts.
Yeah, and I think even that's true for bank statements, checking account statements. I mean, there's people that, sit down and they're like, yeah, my checking account just seems to be dwindling down. And they bring in their checking account. We look at their statements and we find, oh my goodness, did you know you're being charged $59 a month to have this preferred checking account? Look at your statements, look at the fees, make sure you're getting exactly what you need and what you pay for, what you want to pay for. It helps you to understand how this is being done to you or for you. And it there's no reason to have surprises.
Right.
So it gives you the ability to ask informed questions, whether it's health insurance, how come my deductible didn't apply to this procedure? How come it did deductible get applied? How did it get applied? This is all building financial clarity, and it builds confidence and control.
And in today's world, with the ever-increasing risk of fraud and misinformation out there, this helps just provide some clarity and give you some protection. I think that's the big one. Whether it's an insurance bill, don't just pay it because it says a number. Make sure you're understanding what exactly you're paying. Just like we talked about with the investment statements, make sure the fees are what they should be. And even your bank statements, are there transactions that seem strange or unfamiliar? I always tell any client I work with, I do it myself once a month. I take 2 minutes maybe out of my time to pull up a bank statement, scan through it quickly, make sure there's no transactions that I don't recognize. And as long as I'm not spending, 10, 15 minutes combing through every detail, it's just a quick 2 minute scan down the list. Does everything make sense? Every vendor transaction on there makes sense? And if it does, you move on and you're good for the next month or so.
So we're really glad that you joined us today. We want you to pay attention to these items that are coming in so you can be an expert in your own finances. Again, we're really grateful you listened today. I'm Andrew Boudry.
And I'm Ryan Cummings.
Remember, live today for the tomorrow that's in your heart.
Because you'll never have more time to invest for tomorrow than you do today.
Thank you for listening.
Bread and butter.